Christopher Peel is with us, Chief Investment Officer of Tavistock Investments. Christopher, you will have heard as you were waiting in the green room to come on and you were limbering up ready for the conversation around the desk, us ask Andrew many times about the direction of travel for earnings here and the latest forecast that suggest that actually this quarter's earnings in the United States may be the first dip since I think the second quarter of 2016. Is that a reason to start hunkering down and thinking about how maybe you start to take profit on some of these winners and you just put a bit of cash aside here for future opportunity?
Well, we've been following the earnings in the US, over the last few weeks, and I think on balance they've been still pretty good. There was a lot of speculation that there would be more of a pullback, but when I look at some of the numbers, I'm still encouraged for the future of earnings in the US when you have to obviously adjust for the tax cuts. But under the underlying economy, whether it be the growth numbers or the employment outlook, is still very positive for most of these companies.
Let's get more specific, because it's been a mixed bag, hasn't it? When we look at a Caterpillar or we look at other companies maybe that look as though they are more reliant on sustained Chinese demand. Nvidia was another one. I think they had a bad day in the office when their numbers came through. Depending on where the company is sensitive to the cycle, they've been either better or worse. But hard to say overall they've been outstandingly good.
Well, no, I didn't say they were outstanding. I just felt that they were, what the beat number was around 75%. Obviously the percentage beat was smaller than we've seen. That trend is certainly in decline. But it's still not. There's no cliff. There's an awful lot of negativity in the investment world today, and I don't subscribe to that view that there is positive growth in the two biggest countries in the world, whether it be China or the US, and they're going to pull the rest of the world along with it.
Just going back to the market technicals at the moment and whether we've got to buy a signal or not. I mean, look, we've all been around a long while, dare I say it. Some more than others, Jeffrey. But when Jacques van den Broek, the CEO of Randstad, pulled me up today, I thought, oh gosh, I've got something really wrong here. Because I said to him in an interview an hour or so ago, I said, you've got a 6.3% dividend yield. Despite the fact your cash flows move in the right direction, that seems an extraordinarily high yield for these times, and why aren't you investing more, what have you? And he corrected me, and I thought, I'm going to get in trouble here. He said, I've got an 8% dividend yield. And he was like proud of the fact that it was even bigger than what I thought it was originally. So 8% dividend yield for a staffing company at this stage of the cycle. I'm sorry, something just doesn't smell right to me at the moment.
Well, really, again, where are we in the cycle? I think this cycle will be elongated and stretched out further. Europe aside, the rest of the world still looks, I think, very attractive. And I've been doing this 30 years. I can't get anywhere near as negative about growth in markets as what I'm reading every single day in virtually every research
Let me have another stab at this, and I'm going to leave the oil majors out of this because I think they've proved that they've got their cost per barrel down aggressively and they've justified the fact that they've got heady yields as well. That aside, I don't understand the yields in a lot of these telecoms. I don't understand the yields in some of these pharmaceuticals. I certainly don't understand an 8% yield at a staffing company as well. The FTSE yield, and this is something that Jeff pointed out to me last week or week before, 4.6% now. It's the highest it's been for decades almost. I don't know why we've got such huge payout to shareholders if there's so much concern about the markets. I guess I'm echoing what you just said. I don't know.
Well, yeah. Where do you want to put your money? You want to put your money in bonds with negative real yields. I think that's highly unattractive. And we can go into the size of the corporate bond market, the leveraged loan market, which will cause a significant problem in capital markets at a point in time. But I think equities, because of the dividend yields that are still being paid, are attractive vis-a-vis bonds.
That's a late cycle indicator, isn't it, that we peak on dividend payout just before we roll over into the next slowdown, don't we, Andrew?
It's a risk that normally that's a signal. In fact, I was going to ask you, Chris, that what would be the signals that you're looking for to give you confidence and confirmation of your expectations around growth being maintained, but also the markets having the ability to catch up and reflect that, so having more upside discounting ability to move higher. And what are the signals maybe you look at that make you challenge some of that thinking over the course of the next few months? Are there some things that really stand out as being important for you that will give you, that extra confidence or question some of the view?
Yeah, I think one of the obstacles that contributed to the large sell-off, I think, in Q4 last year was the Fed. I think the Fed has clearly changed its tone. I think they'll probably hike rates at least once or twice, but they've definitely toned down the rhetoric, and they're looking on a month-by-month basis as to what they want to do with those short-term rates. I think there's an awful lot of speculation that global trade will continue to drift lower, as if some of these large trade agreements have not been already signed between the EU and Japan, the TTP. I think there'll probably be some type of positive outcome to the US-China negotiations in the relatively near future. So I don't get, I still think global trade will increase, not decrease, especially with global GDP in the region of 3.5%, which is the 10-year average.
In which case, are some stocks too beaten up, given your optimistic scenario? And I'll cite some of the tire makers. We had a report card today from Michelin that was effectively pointing to the sales to mining, of specialty tires for mining and agriculture. That's typically a cyclical indicator. You've got a response now that stretches to some of its rivals, where Pirelli, Continental, all towards the top of the Stoxx Europe 600 today, and even the rubber maker Lanxess. So do you think that the market has been too pessimistic on some of these stocks, which means that there could be decent upside this year?
Well, that's how we're positioned, and I would tend to think that...
In that sector?
Well, I think yes, indirectly we do have exposure in that sector, but I think the trying to gauge where we are, all markets are cyclical: bonds, equities, foreign exchange, economic cycles. I think we are in the end of a very elongated recovery phase that started out of one of the deepest depressions we've had globally in the last 100 years. So I still don't see a reason to lift off the risk on trade.
What about when there have been other stories that sort of dominate the psychology? And if I come back to the car story and suppliers, there's been enormous concerns about what's taking place with emissions, some of the rules changes, whether consumers are still buying because of the economy, because of a switch away from diesel. Do you let that impact your decision when you're buying into a sector, even though you might think it's been impacted too because of a sort of cyclical bias, where people say, I don't want to own too many cyclicals or risks on? Stocks are going to sell that sector, compounded by the fact that there's almost another big profile that's going to sort of impact the sector, which is the emission side, the regulatory side.
Well, I think my view of the auto sector is it's being disrupted. It's being disrupted by the electric car industry, but it's also being disrupted by people's patterns of the need to own a car. If you're in a city today, you don't. In London, I know many people, including myself, that don't own a car. I can go downstairs and get a zip car off the street. It's much more efficient and it's cheaper. So I think car ownership globally is probably going to go into decline. So it doesn't surprise me that the auto sector is starting to struggle.